Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Scott Nations, president of Nations Indexes, as well as Mark Sebastian, COO of Option Pit. We're here to discuss what recent intraday options volatility is pointing to. It's great to see the both of you, as always. Scott, let's talk about this intraday vol that we've been seeing because it might not be telling the picture that it looks on face value.
Yeah, it's been really extraordinary. Today, we've seen the market, the S&P, go through its range several times. On Friday, just 3 days ago, thank goodness that dip buyers came in. We saw a bunch of volatility, market really weak in the morning, came back, and we ended up gaining a small amount for the week. And then the Friday before that, same sort of thing, tremendous volatility, really ugly open, low rally. And it's really extraordinary, Jill, and we don't pay too much attention to intraday volatility, or as much as we should. But that makes options more valuable because for market makers, they get to use those options that they're long during the course of the day. And you might think that this is really scary, that all this intraday volatility might really lead to a break in equity prices. But I think there's one thing that's going to mitigate that, and that is over the last 3 weeks, or the last 21 days, we have seen people coming in and buying protection. And so, for example, if we look at put decks in the S&P 500, put decks is the normalized price of the one standard deviation out of the money put with 30 days to expiration. If we look at that, you can see that people have been coming in, reaching to buy those puts over the last 21 days. And that's good news. It means that for the most part, investors and traders aren't really strung out. They're not over leveraged. They have some protection. If we look at the same thing in the Nasdaq 100, put decks in the Nasdaq 100, you see the same sort of pattern. That is, over the last 21 days, traders and investors have been buying protection. That's great. That means that they're not overextended. And finally, if we look at tail decks in the Nasdaq 100, this is crash protection. We can see that traders and investors have been buying those as well, those options as well, meaning once again that they have a certain amount of protection. They're not just naked long equities hoping for higher prices. This is all good news. The fact that they're hedged to a certain degree, that they've been reaching to buy these options, these put options, that's all good news. It means that while the market might get ugly, it's not going to get really ugly in a hurry, despite the intraday volatility we've seen recently.
Yeah. And Mark, it's interesting because you noted the same thing as well. I mean, your direct words were Friday's action salvaged the market.
Yeah, absolutely. We were set up for kind of the classic, really ugly Monday, early in the day on Friday, right? Bad Thursday, worse Friday, and then you come in on Monday near these all-time highs because we're really not that far off, right? The S&P is what, $200 off its all-time high. You get a couple of bad days like that. People look over the weekend and they say, you know what, just get me out. And then we come in on Monday and things are really, really ugly. Friday salvaged that. The dip buyers came in. That 50-day moving average in the S&P 500 has been a line in the sand for them. Currently, with the S&P down, as we're recording this, over 50 points, we're looking at our first close below the 50-day moving average since April 30th.
Yeah.
That, which is, absolutely bananas. Q's pretty similar story. They have not been below the 50-day moving average, since April 30th. And we're currently breaking that. That could be a spot where, we do see some selling start to happen. We see CTAs start to take action as momentum starts to push the S&P lower as opposed to higher.
Yeah, which is interesting, Mark, because prior to, it's 2 p.m. or 2:10 p.m. Eastern now. And again, when I saw your notes and Scott notes come over and you're saying that Friday's action had salvaged the market, my first thought was, okay, well, what was different this time relative to April? Because that was the narrative then, right? These massive intraday moves. But this one, up until what we're seeing now was, relatively not as undigestible as perhaps what we saw in April. So if we continue to see this action where it doesn't recover by the close today, Monday at 4 p.m. Eastern, that could lend to some concern.
Yeah, there's two things I'm really watching. One is the expectations for the next Fed meeting. A month ago, we were looking at about a 93% chance that the Fed was going to lower rates. That's dropped to about 40%. So it's no coincidence that as expectations of rate cuts have fallen back, the S&P, the Qs, the Russell 2000, they've all softened up. The other piece that I've been watching, I think the best, they're not directly correlated, but if you want to see a asset that really does show the market's tolerance for risk, what the risk appetite is, it is crypto and Bitcoin. And Bitcoin is now down on the year and is really starting to, pull back significantly. These Bitcoin treasury trusts, some of them are really underwater, and we're actually starting to get close to kind of the holding price of kind of the big boy, which is Strategy Inc. A lot of people, there's been a lot of news around the AI. Is AI a bubble? Near term, I don't know that AI is the problem. I think it's rates. And if there is going to be kind of a near term shock, I think it could actually come from the crypto space more than the AI space.
Yeah, well, that's interesting too, Mark. Crypto is a little bit idiosyncratic, and I think what's happening from the regulatory perspective and the momentum that we saw with the Genius Act, because there was, a bit of a fall off with the shutdown. What's going to happen next? Will that momentum continue to get the Clarity Act passed, which is a market structure part of it, which is critical? So I think it could potentially be a little idiosyncratic, or your thesis could also play out as well, where the AI thesis is still fine. It's intact. Scott, of course, we have NVIDIA after the close this week. That's going to be, a huge factor this week, not just for the Nasdaq 100, but, the S&P as well.
That's right, because everybody is paying attention to CapEx spending in AI. And we've gotten some surprising data from some of these names occasionally this year. I think that, as is often the case with these names, which are trading at extreme multiples, the forward guidance is really going to be what matters. And while we talk about an AI bubble, I'm not certain that it's analogous to what was going on in the housing bubble or what was going on in internet stocks in 1999. These are very richly priced names right now. But to the degree that we actually see the CapEx coming in and people begging essentially for the opportunity to buy NVIDIA chips, then if there's a bubble, it's going to deflate very slowly. I think it's very, very possible that if it deflates, it will deflate in the way that, say, Walmart did over years and years and years, where the stock didn't really go down. It just grew into its multiple. And I think that that's certainly possible for an industry leader like NVIDIA, where it may be possible that for the next 5 or 10 years, the stock price doesn't move, but it earns its way into that multiple. And that might very well be what happens with AI.
Yeah, I mean, that's a great point that you make as well. Scott, Mark, what are your thoughts going into NVIDIA's print on Wednesday as it relates to, the indexes are heavily dependent on how this stock moves?
Yeah, to Scott's point, a lot of people think correction and they think stocks have to sell off. Time can correct things as well. A stock that's dead for a year or two while its earnings grow, we see that all the time. They're actually more common than major sell-offs. And a lot of regular investors don't even, don't see it because there's not a headline there. It's just a dead stock sitting there not doing much as those earnings grow into it. So yeah, I think that could absolutely be the case with AI. Are there probably some pockets that are a little overheated? I mean, take a look at what happened in the nuclear space over the last month, where names like Oklo have, exploded higher and then have given away about 40% in about 2 weeks. There are definitely some names, some smaller names within the space that maybe we got a little ahead of ourselves. But I don't think the AI narrative is over at all. And Scott's thesis is potentially the more likely scenario than a major correction.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.